I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Always good to be with you.
We're going to start off today's show with a few questions from our listeners. One listener is very concerned about the erratic gold-silver ratio. What does it mean if it's bouncing all over the place?
Yeah, we've found that the gold-silver ratio has a tendency to, when it becomes volatile, it's anticipating a change in the overall financial markets. It's most people look at it, and particularly people in the precious metals markets, and they always think it has to go back to 16 because it spent a long time at 16. But when it's out in the 70s, that's a different story. But the main thing is that when it becomes volatile, that's anticipating a change, and when gold-silver ratio goes up, it's suggesting that the financial party is getting close to an end. So it's interesting how it does it. I don't know how it does it, but it's been doing it for centuries.
Another question about the infamous plunge protection team injecting money. Who is that team, and where is this money coming from? Yeah,
there was some money left over in the 1930s, I think, when they confiscated the gold, and then it was parked somewhere, and then about 20 years ago, they realized they could use it to intervene in the stock markets. Now, where you have, and I think it's something to do with the president, plus advisors, maybe Treasury Department, but when you've got a government committee acting arbitrarily, it's usually a dangerous thing, and so we don't know how sophisticated they are with it, whether they actually are buying the dips to provide support or coming in and buying it to try and punt the whole market higher. But it is, at the end of it all, the market forces will overwhelm any attempts by arbitrary committees to, push markets. They can do it for a little while, but eventually it lashes back at them. So I think there's going to be embarrassment on that one.
Higher Canadian interest rates, good or dangerous?
Well, interest rates have been going up a little, and the media have been full of it because they sit down and figure out that, oh yeah, now everybody who is borrowing money is going to have to pay a little bit more interest on their debt. On the other hand, nobody seems to say anything about when interest rates were down, that all those who were investing and hoping to get a return out of their investments weren't getting what they should be getting. Rates go up as a boom completes, and then like Treasury bill rates, they go up during the boom, and the central bank follows the changes in market rates, and then what you want to watch for is when, like the quality side, the Treasury bill rates, used the 6 months, start to decline. That's an indication that the demand for speculative money is starting to slow down. So we're watching that. It's not happening yet, but we'd like to thank William in the Netherlands for the questions. He's always very astute with his questions, so we're pleased to answer.
We'll have more from Bob Hoye right after the break.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, some have suggested when the government starts interfering with the economy, that's when you're going to trigger a recession. Any concerns about that in Canada right now?
Oh, yeah. They've been interfering with the economy for 100 years now, and it happens because you get some, I call them intellectuals, but in this case it could be academic economists who develop a theory that if you do this, you can keep a recovery going. And in the case there's an accident of a contraction, if they flood the money markets, then they can prevent a contraction. The whole idea of the Federal Reserve back in 1912, 1913 was that, sure, bankers and investment people there and governments knew that if you had a severe shock in the financial markets, a recession would follow. Now, that's as old as the hills, that one. But anyways, the intention of forming the Fed was as a lender of last resort. It could come in with some funds for somebody who was in trouble, and then that would defer any contraction. But the problem is that all of the players, from banks to finance companies to brokerages to people and corporations, all get in trouble at the same time. So then when the contraction comes, it overwhelms the ability of government agencies to prevent. The idea is, Jim, it's a lovely theory. Oh, we'll do a little intervention here, and then we won't have a recession. And that was the intention behind the formation of the Federal Reserve in 1913. And since 1913, I think there's been 19 recessions. A Great Depression in the 1930s. And then now you've had in the crash to 2009, they called it the Great Recession. It was the worst calamity in the financial market since the 1930s. So, and now you've got this business cycle out of 2009 is becoming mature. The bull market is becoming mature. And there's a lot of speculation in here. Margin soared to a record on the New York Stock Exchange, and when they're doing loans based upon equity in their brokerage account for sort of like household expenses and consumption and stuff like that. So the system is highly leveraged, and the signs are there suggesting a transition to a contraction. And on this, we watch the credit spreads, which is the difference between investment-grade bonds and low-grade bonds. And narrowing is a sign of confidence and enthusiasm for the markets. And they narrowed into a couple of months ago, and then now it's starting to trend change towards widening spreads. So we've had the first breakout on that was a few weeks ago, and then it's corrected. So now we're waiting to see when the next breakout on the trend change to widening spreads, when it would be. And so we've used this before. 2007, it was helpful in determining the change as it was coming along. And also in 2000, we used that as well. The first breakout to widening was in January, and then the second breakout was in the middle of March, and that was right with the peak of speculation in the high-flying .com bubble of 2000, and then 2007, the second breakout was in August, and the market high was in October. So the lead is variable, but it's an important item, so we watch it closely.
We'll have more with Bob Hoye right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Bob Hoye. Bob, how dangerous is it for people to use an equity account like it's a savings account in the bank?
Well, it's fine if you have it set up where you have your portfolio and you assume, say, a certain return annually, 5%, and you figure, okay, now I'll take out 2% annually, and, for living expenses or whatever, going to dinner at Umberto's, that sort of thing. But the danger is that when you see the rising trend, and, we've all done this, is, let's buy more stocks, because you own more stocks, the price goes up, you're making more money. And that one is very long time in the market. So, and this is what's been happening lately, is that you just compound your gains that way, and gosh, the returns are fabulous. But the problem is when the stock prices go down, the amount you owe doesn't go down, and so you have to cover it one way or the other. And as a stock market operator in the 1800s, Daniel Drew is attributed to the phrase that he who sells what isn't his'n must ultimately deliver or go to prison, which is then the short side of the market. So the way it works with the leverage, it's great when it's working for you, and then the prices stop going up, and then they head down. And while the senior central banks may be trying to boost the stock markets, which they have been continuously, that once the prices start going down on a highly leveraged market, then the power goes over from the central banker to the margin clerk. Now, lately, with central bankers becoming so reckless, you could sort of say that their job lately is to get the accounts out of line, by meaning having such a positive market that everybody leverages up. And of course, the margin clerk, his basic job description is entirely different, and his job is to get the accounts in line, where the debt is covered by the equity. And so this is where it becomes very powerful, and this is why you've had 19 recessions and 19 severe contractions in the financial market since 1913, is because when the markets get leveraged, the power shifts to the margin clerk, and his job is to get the accounts in line, which is done by having the account, come up with money from elsewhere. But then if he's totally leveraged, there is no money from elsewhere. So then the problem is solved by selling out the equity. And then sometimes if the market's fast enough, by the time you sell, you've got no equity left. And this is a tragedy, but it's been happening for centuries, and I wouldn't wish it on anybody. But the next few weeks, if one is leveraged, it would be advisable to reduce the leverage. And then, of course, the other one that we always advise is after Labor Day, you don't wear white shoes or a white belt on your trousers, and that's a matter of taste, of course.
Bob, always a pleasure chatting with you.
Jim, good to be with you, and we look forward to next week.
My guest has been Bob Hoye. He's a market historian and the chief investment strategist for institutionaladvisors.com. If you have any questions for Bob or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.